You are listening to ChartingWealth.com, our market review for Thursday, the 14th of May, 2015. Let's jump right into things. What do we always do first? We always look at IYY. This is the total market. Here is where the two-day chart finished up on Wednesday afternoon. You can see that the market closed down. That is on the two-day chart. Now, for Wednesday itself, it was down 0.11%. We've tried to draw a two-day trend line here. It's above that trend line. We're still in a continued down movement. The biggest thing we always look at is the moving average convergence divergence. It turned over back between the 28th and the 30th, and this continued to go down. Derivative oscillators also down. The market is technically in a down position. However, you can tell over the last 3 days, you could draw a trend line going up, but, well, that's getting too technical. Where we stand right now, though, is, of course, what have we talked about over and over and over? Sell in May and go away. We're entering into the summer doldrums where the market will slide sideways. It'll be very difficult to chart because as the market moves sideways, the MACD, which is our best indicator, is hard to use. What do you do in the summertime? Well, that's why they say sell in May and go away. You trade, you invest when you can, and you don't when you can't. So let's look at what's happening on the 4-hour chart, see if it gives us any better insight. Now, this is what happened throughout the course of the day. You can see in the morning, up, in the afternoon, down. And again, overall, the 4-hour chart shows that it closed just under the two-day trend line. So again, and it looks like if you look at the 4-hour chart, and again, this is a smaller chart, smaller wave, it was actually in an up move. It looks like it's losing its power, might be crossing over, going down to parallel the two-day chart. It's always helpful when both your charts are moving in the same direction. Makes it easier to forecast what's actually going on. Now let's go back to the two-day chart, and we're going to look over. We always go from IYY, the total market, to SPY, which is the S&P 500. Again, this is an ETF, an exchange-traded fund that tracks the 500 big companies that make up the Standard & Poor's 500. We can see the same kind of thing here. Crossover going down between the 4th and the 6th of May, still in a down move, derivative oscillators paralleling the moving average, convergence, divergence. What else do we see? Well, you can see that it closed below the two-day trend line on the two-day chart, technically in a down move. Market itself, SPY, the Standard & Poor's 500, was down hardly at all today, 0.03%. That's not 3%, 0.03%. Let's go and look over at the 4-hour chart, and you can see there's our two-day trend line, and it closed under that. This is what happened in the morning, and then in the afternoon, morning up. The bulls got the market up pretty well. The bears pushed it down, and it ended down barely for the day. Again, look at that crossover going down on the 4-hour chart. Derivative oscillator losing its speed. The 4-hour chart is now matching for the SPY, the Standard & Poor's 500, the down move on the two-day chart. So we're in a down position on SPY. Now let's go back to our two-day chart and switch over to the Qs, my favorite index, just because every dollar is a strike price, and it's quite liquid, although it has lost a lot of participation over the last year or so. So the QQQ is the NASDAQ 100. That's what it tracks. And what do we see? Well, we tried to draw a two-day trend line. It has been broken on the two-day chart. It is still, of course, technically in a down position, having crossed over between the 4th and the 6th on the MACD, and our derivative oscillator is also bearing down. Now again, what are we running into? The market sliding sideways. It's been trading over the last 1, 2, 3, 4, 5, 6 days within what? This candle way back on the 6th of May. That's not showing you a market that's doing a great deal. Okay. Now let's back up and look at our 4-hour chart and see what it tells us. Well, we can see that we closed right there on the two-day trend line on the 4-hour chart, and look at the MACD. Can you even tell what it is? I guess technically the MACD is going down, but that is some sliding sideways moves there. Hard to read the MACD at all. Again, the derivative oscillator losing speed. I guess technically, yes, the MACD is now negative, but yeah, that you can see, if you can see it, if you're listening not just to the audio, but the video, I can tell you a very, very tight line. We are talking convergence, not any divergence. So the market's sliding sideways right now, at least on the 4-hour chart. Again, in a technical down move, as is the 2-day chart on the Qs. Now, let's go back to our 2-day chart and let's see what is gold doing. Look at gold. It popped finally. We have been in an up move on gold. Let me range back out here. Look, gold crossed over going up way back between the 25th and the 27th of April. It then, no, I'm sorry, not even April, March it crossed over. It did go up quite nicely for many days, and then it started sliding sideways around the 8th. And it is still, let's see, even today, it did not close above where it closed on the 6th. Gold, even with the down moves, and we have a 2-day trend line that we drew that was finally broken today with this huge surge in gold. It was, as we told you, technically in an up move this entire time. There was nothing as far as the indicators go that told you to get out of gold. Slid sideways this whole time. Crossed over today going up on the derivative oscillator, had been in an up move, and shot up today. Now let's get some idea by going and looking at the smaller chart as to exactly what had happened. We saw it cross over going up on the 4-hour chart back between the 11th and the 12th of May, and then it has continued to surge up. On the 12th, it went up both 4-hour periods, and then of course today substantially, and then of course this morning, and then this afternoon. Gold up 1.77%, almost 2% today. Gold is continuing in an up move. It is moving up both on the 2-day and the 4-hour chart. Now, of course, does that mean that you go buy gold if you weren't in it before? Well, it's already peaking out of the Bollinger Bands. Those are the volatility bands. There's no air outside the Bollinger Bands, so it'll always come back into that. So, you don't want to buy high and sell low. You want to wait for a good buy-in point before you buy. We will be doing plenty of trainings on how you determine when to get into and out of a position. But buying when something pops is rarely the time to start putting your money into something, because it may already be inflated. Once buyers start getting excited, that is when the greed factor kicks in. And also when things start tanking, that is when the fear factor jumps in and people keep tanking a lot of times. So that is where we ended up in gold today. Nice to see gold starting to move substantially back up again. We'll continue to track it. Again, it still has not reached its high back in the month of, well, you can see all the way back into February when it had reached all the way up to somewhere around 125. It's at 116 right now. It still hasn't reached its high of 117.47 that it reached back on the 6th of April when it started slipping sideways and going down on us. So continue to watch gold. You can see where the Bollinger Bands have moved in as the volatility decreased over this sideways slip, and we'll continue to watch it. Technically, gold is up, and the other markets that we talked about are down. Thanks so much for listening to us. We appreciate you. We do encourage you to please go to the website, chartingwealth.com. Engage in the trainings that we have there, all of the different postings, and make sure that you subscribe for our daily newsletter. We'll send you out this broadcast every single day, plus good training on Tuesdays and Thursdays. Thank you so much. We appreciate you joining us. We love to see your responses on Facebook and Twitter. Follow us at both, and just keep up with us. Thanks so much. Wish you the best in trading and investing.